This is the Daily Market Rundown live from the Tradelo Trading floor. It's November the 11th, and some highlights from today's show. The BOJ's intervention is now in play, Bitcoin is soaring, and US real yields are plummeting. Good day, traders. Let's start with some of the weekend news. It was all about Bitcoin. Of course, it's now broken out. It's gapped up in the futures, of course, and we are trading just shy of around $82,500. We'll talk a little bit more about this in the charts in a moment. But the key sort of takeaways from the past week, now that the election has gotten out of the way, is very much that the MOVE index, the bond volatility index, as well as the VIX index have both been squashed. Now, this will have implications for markets over the course of not just this week, but into year end. And it very much invites in more upside, particularly in the risk markets, as well as the bond markets, to just settle down now into a bit more of a range until we get further economic data. Now, I think the best place to start in terms of some of the news is just a little bit of an update on the US election. Of course, there's still some voting counts that are ongoing. It's not yet concluded that the House vote is finished. It's very, very much leaning in the Republican direction. What we are seeing in the Senate is now confirmed to be Republican, but the key takeaway now is we just need that final confirmation that Republicans do control both houses. They're currently sitting, they need 5 more votes to secure the House. They do have a slight lead in 9 of the 17 outstanding sort of votes to be counted. So very much looking like they'll get those final 5 election results. But, and again, this is the caveat, the market has assumed that this race is done. Okay, and I think by and large we need to assume that the race is done. But we have to be very switched on. We have to keep track of those House votes, because if for whatever crazy ass reason that suddenly shifts, keep in mind the entire market is now priced very firmly for a House under the control of Republicans. Okay, should that change, think equities down 3-4%, think Bitcoin down 10%, think bond markets rallying quite aggressively. That would be the situation should that, for whatever reason, change. So just keep an eye on that. And then I think some of the other key news is with regards to the Bank of Japan. They released their minutes. Again, I think the key takeaway from this minutes, if you read through it, is the hawks saying one thing, the doves saying one thing. They're all pretty much saying a different thing, which suggests that we've got a real lack of unanimity at the BOJ. They're really not sure what they're supposed to be doing. Now, I think what we have to do as traders is we have to understand where the opportunity scope is with the BOJ. Right now, the market is not really convinced they're going to hike again this year. And I think, unfortunately, the situation is they're going to be forced into a situation of hiking. Now, again, if we just cast our minds back to earlier this year, it was very much the weakness and this speculative activity going on in the yen that drove the BOJ to hike in July. We then had, of course, quite a bit of volatility across all the markets. Okay, and that's what led the BOJ to sort of back off and say, well, we need to be very, very cautious about any further additional hikes. Okay, that was just simply because there was this narrative that the carry trade was coming unstuck, bonds were going to collapse, equities going to collapse, the world was going to collapse, simply because the BOJ hiked, by rates to 25 basis points. The point that you want to take away from this is that there's a very, very little chance of another hike this year, but I think the chart is ultimately what's going to force them into a situation of hiking. Okay, if you take a look at the yen, this is a weekly chart. You can see that over the course of the last 7 weeks, 2 months, we're down 10%. Okay, now don't forget, weak yen is problematic on a number of fronts, and most important for the BOJ is that it does mean that Japan will be importing inflation. Okay, what we can see, and I've put these 2 little lines on there for you, on purpose. If you go back to 2022, this was actually the first time the BOJ intervened in their currency, and we can see that the move in the yen was quite dramatic. Of course, over the course of the next year, the yen weakened again because, well, they have negative real rates, the rest of the world has positive real rates. At the start of this year, we got a bit of volatility in the yen, and that's the point at which the BOJ again began the process of intervening. If we look at the first rate hike, that's where it was. They realized that if they were going to keep trying to prop up their currency, it was going to be a losing battle, so they decided to hike rates. Okay, the result was, yes, we got a couple of those shorts squeezed out, but again, they are now taking on the yen. At the end of the day, the BOJ is sitting with negative real rates. The US is sitting with massively positive real rates. There's only one way this is going to go, okay, and that's further to the downside. It is going to force the BOJ into having to hike rates again this year. So what you have to do here is you actually have to look at this from the standpoint of, as this market moves lower, so let's say we trade down to 64s, and then we trade down to 63s. As we get closer towards those July lows, I think you have to just stand in the way, make sure you're long that market, because the intervention or the commentary coming from the BOJ is going to come out of nowhere. Okay, it's not like you're going to be, switched on for it. You almost have to look at this as a risk-reward play. You've got to be willing to buy it down here, assuming that the BOJ will not allow for further depreciation in the Japanese yen. Okay, so I think that's one of the key things to pay attention to now. If we go and have a look at some of the overnight moves, it was all about the US stocks last week. We had Tesla up 30%. Nvidia was up just shy of 10%. It really was a strong week for the US equity markets. But coming into this week, it's very much a continuation of some of those election themes. I think one of the key standout ones is we've got a significantly strong dollar at the start of play this week. We can see that across the board. Gold is even down 0.8% at the start of play. We've got euro down 0.5%, pound down 0.3%, and of course the Japanese yen down 0.7%. So a number of the currencies are weakening against the dollar, and that's just simply because the assumption now is that the Fed's not going to be able to cut as much as they want to next year, with all other central banks are likely to continue the process of cutting. Now, with that in mind, I think the next market to talk about is very much Bitcoin. We've broken out, and again, I think sometimes as traders, you'll read a lot about Bitcoin going to the moon and Bitcoin just going up to $1 million like Kathy Wood seems to think. Sure, maybe it gets there, but for us, from a technical analysis standpoint, a little trick that you can deploy, it's something that's worked well for me over the years, is when trying to gauge a target on a breakout, what I like to do is I like to look at the range of the flag. Okay, so I like to look at this sort of range that we formed in this flag and get a rough estimation of that range. So call it around $15,000 was the range of the flag. What I then like to do is I like to superimpose that above the breakout. Okay, so if 74,000 was the breakout, we add on 15,000. We're looking somewhere around that 95,000 area up to around 97. Okay, depending on how you measure that flag, that's how I measure a potential target. And the way is that if the market is breaking out and is a long-term breakout, I don't want to be getting out too soon. Okay, so I use this almost as a metric. You can see I've plotted it on the chart. I use this almost as a metric to just make sure I don't jump out too soon. Okay, so looking at current prices of 82,000, well, there's still a lot of upside opportunity based on this approach I've used, so I don't really want to be looking to scale out just yet. Okay, sure, maybe we get up to 90,000. At that point, fine. If we start to see a lot more of this two-way trade, perhaps I will scale out of a little bit, but it's very much to just ensure that I don't get out at the start of the breakout, rather I get out towards the latter half of the breakout. And to understand the degree of that potential, I just simply use the size of the flag. Okay, so that's one consideration. Now, with that in mind, of course, we're up a lot. We're up almost 100% year to date. We're up, almost 20% month to date. But this is not a market that you want to be short of. There's just no real good reason to be short of it. We're in price discovery mode. And what that suggests is we're probably just going to be bidding up the page. Where it stops is anyone's guess. Okay, no need to provide the short here. No need to try and be, intentionally smart. If you don't feel comfortable buying it because you just don't like this product, well, then don't trade the product. Okay, don't stand in the way just because you want to prove a point that it's perhaps a little bit overbought in the near term. Okay. Now, our final topic of the day is all about real yields. I posted a tweet on this, and I think it's important you understand this chart. Real yields is not something you need to worry about too much. You generally want to worry about them when they're moving. Okay. Now, what you can see is over the course of the year, if we look at real yields, they are in purple. Okay, and we can see that real yields typically do nothing, but at some points in time they do trend. Okay. If we go back to the COVID years, real yields collapsed. Why? Well, central banks cut interest rates to the zero bound, and they did effectively bazooka-style quantitative easing. Okay, so they were incentivizing, they were stimulating via real negative yields. Okay, a negative yield, we simply just take the current interest rate minus inflation expectations. Okay, now in a negative real yield environment, what a central bank's telling us is they're encouraging risk taking. Okay, they're encouraging spending. They're trying to give people the opportunity to spend and create demand. That's the purpose of negative real yields. And obviously the opposite is true as well. So when we have very positive real yields, what we're trying to do is disincentivize spending. We're trying to disincentivize leverage, because we're making it expensive ultimately to borrow money. Okay. Now, what we can see is that there's been two cycles. Real yields dropped post-COVID. They then rallied after COVID. Why? Well, because central banks hiked interest rates to sort of historically high levels. Okay. Ever since then, over the course of 23 and 24, you can see we kind of stuck between a 3 and 4% real yield environment in the US. Now, why does this matter? Because like I said, high real yields technically is not good for risk markets. Okay, high real yields is technically not good for the gold market. And that's the other market I've got here in the orange, is gold. Okay, and yet what we can see in this high real yield environment over the course of the last 18 months is that, in fact, gold has actually rallied. Now, that's very, very unusual. Okay, if you look at the playbook of gold, you don't buy gold when real yields are high. You sell gold when real yields are high. And I think this tells us a very important story. It's telling us that investors are not satisfied that ultimately real yields are high enough. Okay, now, of course, this is just me trying to understand why gold has rallied in this context. But the reality is, if gold's rallying in an environment where real yields are very high, it's telling us that real yields are not high enough to justify investors moving into bonds. Okay, you always have to think of the investment landscape as well. I can own a number of different assets, and I want to own the assets that give me a great return with a low risk profile. Okay, so in a high yield environment, it makes absolute sense to own bonds. Okay, why? Well, because if I'm earning 4% real yields, it means I'm beating inflation by 4%, and I'm owning United States government bonds, which are relatively low risk. Okay, so that's the logic. You would think that bonds should outperform in a high yield environment relative to gold, and yet they aren't. Why? Because investors just don't want to hold bonds. And I think that's the message to take away from this, is that bonds are not a good buy currently, simply because they're obviously not offering a high enough yield to entice investors. And I think that's the key takeaway, and it does line up with this idea of perhaps fiscal irresponsibility from the United States government, perhaps this idea that yields don't justify the higher level of inflation. Whatever it might be, the market is sending a very clear signal here that yields are not high enough to entice investors to own bonds. Now, I think that becomes a theme next year. I think at some point we are going to stage a bit of a sell-off in bonds. We'll need to do that. Otherwise, what's going to happen is these real yields are going to keep pushing lower, and as a result of that, gold is going to keep pushing higher, risk market's going to keep pushing higher. Okay, I think that's a very, very important theme to understand, to be aware of, because I suspect at some point next year we are going to deal with quite an aggressive sell-off in the bond markets, and that will have implications for a broader market. So just make sure you understand that concept of real yields. It is an important and interesting one. Now, in terms of today, it's very much a quiet day. It's Veterans Day. Also, like I said, the VIX is back to around 15.5. The MOVE index is also sold off quite aggressively. So it's a quiet day across the board. I don't expect anything to happen. We've got no real headline data out today. We do, of course, have Powell later on this week on Thursday, which will be interesting, as well, of course, the CPI on Wednesday, which will be the key event. Okay, right now, the only thing standing in the way between Powell and co cutting in December is, if inflation was to tick higher than expected again. So it will be very closely watched later this week to gauge whether or not, the Fed's going to pause in December or perhaps continue with the rate cut cycle. Okay, apart from that, it's not a great deal much more out this week, so we are going to be dealing with some of the last bits of election flow. Otherwise, that is it for today. If there are any other questions, do post them in the chat channels. Otherwise, good luck out there. Always manage your risk. Go make some money.